Today I want to finish up the class notes on value at risk, just a few final thoughts, nothing more major. We've covered almost everything. Fascinating topic, got into some controversy there. And then we want to start getting ready for the project, the risk project. So I'll walk you through that. You're not going to get too much into it until the first exam is behind you and paper one's behind you. So there's no rush. It's not a project that takes a lot of time to do the Excel work. So we'll get through that today. So just a few comments. So VAR is used extensively. You're all seeing it in your banks in your paper one discussion. It certainly has its distractors. I met with a managed futures hedge fund manager from the UK, and he did his presentation and never mentioned VAR once, which is pretty unusual for a hedge fund. So I asked him, why didn't you give us your VAR? And I wasn't a huge fan of VAR, though I used it. I like it in some context, but I wasn't upset that he didn't show the VAR. I just was curious. And so he told me this story. I even got his permission I could use this in my class because I thought it was interesting. But he said he didn't like VAR. And he said uncertainty and risk is like a cliff, and everyone stays safely away from the cliff. And then he said VAR is like building a fence along the cliff. So now everyone with VAR feels comfortable coming up to the fence and looking over the edge of the cliff, and they're all leaning on the fence. And what VAR does is get everybody to do the same thing at the same time. So you have all these people who before were staying 20, 30 feet away from the cliff. Now they're all right at the cliff, leaning against the fence all together, and the fence collapses. And now, because of VAR, because of the fence, the damage is far, far, far worse. So VAR ignores the fact that a lot of people are doing the same thing. We'll talk about this more, especially when we get to Doug Hubbard and what he says about contagion risk, that we're all doing the same thing, but we don't know we're all doing the same thing. And then when things blow up, everybody's shocked. They're like, my word, we're all doing this trade, and the crisis is made doubly worse because everybody's trying to sell the same things. And so that causes, in the middle of a price sell-off, the price drops even more because of the liquidity crisis, and it's just this mushrooming, incredible disaster that VAR somewhat enables because it gives people confidence to do things that they wouldn't normally want to do in other times. My own personal views, I like his view. I think that makes sense. My own personal view, VAR tells us to ignore those risks that have a very low probability. So once you decide your VAR, your risk tolerance to say is 0.5%, you're essentially saying ignore anything that happens less than 4.5% of the time. That's actually the risk I'm most concerned about. And it's mainly the reason I'm concerned about it because they happen so much more frequently than our models say they should. The 2008 crisis, the COVID crisis, the dot-com crisis, the 87 sell-off. We're seeing things happening about once a decade and even twice in the decade between 2010 and 2020. And now with COVID, we've essentially had three in about a 10-year period, maybe 11 years. And each one of those were practically impossible according to our models, and yet we had three of them in a decade. So I'm obsessed with those type of risks because they happen much more frequently than our models say. So our models tell people ignore it because it's so infrequent. I'm like, no, I'm not going to ignore it. I'm concerned about that. The other issue we have is this whole issue of can we actually figure out what our risk tolerance is? How we manage our investment risks should be consistent with how we manage other risks, and yet we find that people's risk tolerance is inconsistent one decision to another. We should be if we really have a risk tolerance, that should be the same for our investing, for our insurance purchases, for what careers we choose, for what colleges we go to, for what skydiving we do, those kind of things. There should be a consistency there. Why would we be risk averse in one area but not in the other? And yet, almost everyone purchases homeowners insurance, and most people don't even think about it. It's like, oh, I have a house, I have to have homeowners insurance. But very few purchase insurance for their investments. And that's what we talked about previously with options, using options to protect the downside. But the probability of fire destroying over half of your house is a far lower risk than the probability of your portfolio dropping in half. And a lot of people who insure their house have a portfolio that's much larger than the value of their house. That's not true for a majority of people, but there's a good 20% of Americans whose investment portfolio is larger than the value of their home. And yet they don't think anything about insuring that, even though there could be a huge drop. Now, from a relative basis, it's probably cheaper to insure the house against fire than it is to insure your portfolio because the volatility is higher. However, you might be shocked at how much less expensive it can be at some times. Options can get really, really cheap when that volatility index drops to below 10. I'm really amazed at how inexpensive it is to insure a portfolio. So it's a lot more volatile. The cost of the insurance is much more volatile for the investment, but people are never even looking or considering it. So that's what amazes me. It's not that they don't buy the insurance, it's that they never think about it. They never think about home insurance because they always buy it. They never think about the investment insurance because they never buy it. And yet they're comparable risk in many ways. You would think people would at least look into it and think about it, but it's just completely ignored by most of the industry. The other issue is how insurance works. Insurance is a very economically efficient market. When the risk of fire increases, they increase their premiums or they may not sell you insurance at all. But as we talked about with options, when the investment risk rises, option prices are usually their lowest because investment risk is at its highest when people are the most complacent, when people aren't thinking about risk. That's when they're bidding prices up much higher than they should be. That's when you should be worried. And fortunately, unlike a homeowner's insurance, fortunately for investment insurance, the insurance is cheapest when you most need it. That's an amazing thing. I do have some blogs out there. You could read about my blog for older investors. We've really already covered that. That was my option strategy. For young investors, you can read my blog there. My approach is, and this is really, I think, key for younger investors. So many websites, if you're 25, 30 years old or 22, 23, and you go in and look at what you should do, most of them will put you 90% in stocks, 80% in stocks. And I think that's kind of ridiculous. Why go 90% in stocks and 10% in bonds? If you're 90% in stocks as far as the dollar allocation, your risk allocation is almost 100% stocks. Stocks are so dominating your portfolio, you hardly even notice the bonds. So I say, hey, just stick it all in stocks. Why not? And that's not exactly what I recommend in this blog, but I don't understand the 90-10 because it's so skewed toward stocks. It's true, if the stock market crashes, 30%, if you have 10% portfolio in bonds, you only lose 27% minus whatever, 0.05 you get from the stocks. So maybe you lose 26.9% instead of 30%. I don't think you're really going to notice that, especially when you're young and you're building a portfolio. I say just put it all in stocks. You'll get the highest return that way. It'll be more volatile, but not much more volatile. And why not? It's on the efficient frontier, right? It's that last point out there. Why not? But very few financial planners will say anyone should be 100% stocks. But I have some other approaches in there. I kind of like for younger investors this concept of trying to find the next Microsoft. So 80% of your portfolio in stocks and the other 20% very opportunistic. Maybe it's a Bitcoin trade or something where you just put money, 1 or 2% in something that you think's really going to work. Could be a Tesla, it could be Uber, it could be anything that you think could take over, become really the next big thing. You'd be better off finding something that's really small company that you think is really going to take off. I had a student send me a text this week on a company he's really excited about and has been investing in, but is priced to go out of business. So, if you do that, if you think about it, you put that 80% in stocks, the other 20% you're very opportunistic. You can be wrong on 19 of those 20 things. So you put 1% in 20 different things. You can be wrong on 19 of them, and one of them be the next Microsoft or Apple, and you'll make a fortune even if the other 19 lose 100%. Because the most you can lose is 100%, but you can be up 40, 50, 60,000%, 100,000% easily on a stock that's a smaller company and starting out and has some new some new high growing product that people are buying. So you can read my blog if you want to view on that. You can wait until the semester's over if you want to, because that's not really tested in what we're doing. We covered the options pretty well. I just didn't cover this young investor that well in this class, but you can definitely go read for yourself. To give an example of where VAR analysis could actually be valuable, and we'll talk about later, we're going to talk about Orange County. Orange County is the perfect case where VAR would have been very helpful, would have really showed them not to do what they were doing. It would have shown they were taking way too much risk. But here's another one, the Pension Benefit Guarantee Corporation. This is an entity that insures pension plans. So if a company goes insolvent, this PBGC, they come in, they step in, and they guarantee with U.S. federal tax dollars and maybe some dollars donated from the pension plans. They step in and they guarantee and protect that pension plan. So a few years ago, prior to 2008, someone came in and said, we got all these assets sitting here waiting for the next pension blow up, but we're sitting in really, really low risk conservative investments. We should have an allocation to stocks. And so they greatly increased their stock allocation, and then you had the 2008 blow up. If you use value at risk in there, and you use value at risk not of the portfolio, but value risk from the taxpayer standpoint, value risk of what they were having to guarantee, they would have discovered really quickly that moving the PBGC heavily in the stocks was a really bad idea. Because why? Well, in 2008, when the stock market is crashing, when their portfolio is crashing, they're going to be picking up a lot of pension plans because there's so many companies going under. So at the time that their pension plan is crashing, where their assets are crashing, they're getting more liabilities. It's just the perfect storm being set up. It's the same thing we talked earlier about with endowments. Endowments have donors, they have an in portfolio, and they have a liability, they have clients. And if they invest heavily in stocks, then when you have a 2008, the donors stop giving money because their portfolio has been killed. The endowment itself has seen its portfolio crash. And then their liabilities are going up because their clients, because of the financial crisis, are demanding more. Those are the times I think value at risk can be real helpful, so that you can see the extremes. Those are what we call perfect storms. I don't know if you're familiar with that term, but a perfect storm, everything just aligns. A lot of times people talk about a perfect storm and being completely unseeable. It's impossible. How could you see all those things come together? But if you use value at risk correctly with the PBGC or with an endowment or even with a pension plan, and you set it up, what you'll discover is those perfect storms are actually correlated. They actually make sense. It makes sense that the donors would give less when the stock market's down. It makes sense your portfolio's down when the stock market's down. It makes sense you have more clients when the stock market's down. And so you're loading everything up. So it's not a perfect storm. It's actually a storm, a disaster you created, or the person who's doing this created, by having so much betting on not having another recession. So at the extremes, that's where I think you really understand risk. And that's where seemingly uncorrelated things suddenly become highly correlated. And again, Doug Hubbard, I'm going to show you his view of this, his idea of contagion. That these things that should happen every trillion years, and then they happen more frequently than that. Why? Because of this domino effect. So many things are more integrated than we ever thought was possible. And so things that shouldn't happen, they should be almost impossible, they happen because there's things that are just causing each other. There's this domino effect at the tail. So you don't have to go down to the 0.0001%. You get down to that 1% or 0.5%, and suddenly everything starts moving together. So you need what we call a contextual view of risk management. You need to view risk management, and it almost gets back to what we talked about earlier in environments. Thinking scenarios. With your paper one, you talked about stress testing. So it's that kind of idea of a stress test. It's like, wow, what if this is at the extreme? How will that influence everything else? So we'll get into this more. Doug Hubbard is probably the best at this. So we discussed the investment community is much more focused on career risk than on their clients' risk. With the investment communities worried that the stock market's overvalued, what did they do? They don't go from a 60% allocation to stocks to 0 or to 10%. they might go from 60 to 55. Why? Well, because if they reduce their stock allocation more, they could, and they're wrong, and stocks go up, they could get fired, they could lose their clients, they have career risk. So they don't move much. I remember having a discussion with the exec council at UTSA, and one of the presidents of one of the companies, a really sharp guy. I really loved working with this guy. Very, very brilliant. He wasn't an investment person. He was always very complimentary of my department. And he would talk about, I'd walk in, he'd talk about, yeah, you're talking about stuff I don't understand, Ron. But he understood it. He caught on it real quickly, and he picked up really quickly. Just say, hey, this industry, they tell me they think stocks are overvalued, but they're scared to get out of the stock market. They just stick with it. They don't do anything about it. I remember reading an article by an investment person who said he thought the stock market was overvalued by 50%. And he was real confident about it. He thought stocks was just really a horrible place to be. And so the interviewer who was writing this article asked him, well, what are you doing with your stock portfolio? He says, oh, I'm just sticking with the 60-40. I think that's a good allocation. 60% in stocks. And it's like, why would you be 60% in stocks if you're convinced the stock market's 50% overvalued? It just doesn't make sense. So there's like, we have these opinions, but we're scared to do anything because we're scared to be unconventional. So here's my quote. And this is my quote back. We had this earlier when we were talking about pension plans. This industry is focused on the small things from the client's perspective. Now, from their perspective, they're focused on the right thing, career risk. But they're focused on the small stuff. From the client's perspective, the client's not thinking, wow, your benchmark could be up 8% and you might only be up 7.5%. That's really horrible. No, the client's thinking, wow, I could lose 30% of my money. So our industry's focused on the small stuff. And this is my quote. It's a really bizarre quote. But my quote is, when you have a gun to your head, that's not the time to be focused on your cholesterol level. Now, we'll talk about this a little bit more. Why would someone do that? But think about the absurdity of that. So you see someone is held as hostage, someone has a gun to them, and you call them up, and the person who was holding them hostage says, okay, I'll let you talk to him on the phone. So you get him on the phone, he says, okay, we see your predicament, what do you want us to do? And he says, yeah, man, this is really scary. I just came from the doctor, and my cholesterol is well over the limit. I think what you can do, if y'all could get me some better food that's low cholesterol, I need to get my cholesterol level down. You would say, wait, am I talking to the right person? Did you put the right person on? You got a gun to your head. And the person says, oh, well, I know I have a gun to my head, but I don't know anything about this person holding me hostage. I don't know if he's crazy. I don't know if he's done this before. He might just be depressed. I don't know what the probability of. There's no way for me to measure my chance of dying from this guy with the gun to my head because I have no data. However, I have a lot of data on my cholesterol. So he says, I'm focusing on cholesterol because I can measure that. And since that's measure, I can do a lot about it. I can't measure the guy holding the gun to my head, so, let's focus on what we can measure. And that goes on so much in our industry. It seems just crazy. Why would you ever do that? But people say, well, I just can't measure that. There's not good data. We're going to talk about that. Definitely, Doug Hubbard has a lot to say about that. Don't ignore the most important risks just because you don't have good data for it. Measure it. Put the data down that you have. Buy more data. Do what you have to do, but focus on the big risks. Don't ignore them just because they're hard to measure. So we talked about risk. You've done parametric risk. You've seen how that works. You did several problems like that, in preparation for exam 2. Exam 1. For exam 2, you're doing parametric VAR, but using correlation and doing a little more complex. Historical VAR, you'll do this on the project. We all saw a little bit of that when we were doing the more complex VAR problems. But you'll definitely do historical VAR on the project. Stochastic VAR, we somewhat hinted at it on the when we're talking about the more complicated VAR problems. But parametric VAR, you just use the statistics. Historical VAR, you run simulations, but using history. So you just go back to, most of your banks were doing some form of historical VAR. Those stochastic VAR is when you're using history to set assumptions, but then you're running simulations, brand new simulations going forward. Stochastic VAR, you can do all kinds of things. You can bring in consideration what the current market data is, economic data is. You can incorporate some reversion to the mean. You can have correlations that are unstable and risk is unstable. You can do a lot of things that are much more sophisticated. I've seen students do some. I really need to incorporate it into this class eventually, but doing some stochastic VAR using just a good old random number generator in Excel. So it is possible to do some fairly sophisticated stuff with Excel. We already talked about how historical and stochastic works. You rank order all of your scenarios. Then you take the number of simulations times your risk tolerance, and you find that from the end. So you have to add 1 back to it. So if you have a 10,000 simulations and your risk tolerance points 2, you're looking for the 20th from the end. The 20th from the end is 9,981, not 80, but 81. You subtract the 20 from 10,000, have to add 1 more back because you're counting the number 10,001. So we saw that, we practiced that when we did the video for the VAR problem. We already saw this as well. If stochastic or historical VAR are inconsistent with your parametric VAR, it's probably because the distribution you're looking at is not symmetrical, and parametric VAR assumes things are nice and normally distributed, nice and symmetrical. So you're getting a fatter tail with the historical stochastic VAR. And we'll see that when we do the project, and we'll see some examples, especially because when we do historical VAR, we're going to have 2008 in there, and now we'll have 2020 in there. And so you might see some events that are more negative than what the parametric VAR would say. So let's get to our project now. So this is how the project is going to work. You're going to do 3 things in this project. You're going to create an efficient frontier for a client that you make up. I'm going to show you how to do this. You'll create a client, and based on the client you set up and your efficient frontier, you're going to make a recommendation for them. You're then going to assess that recommendation both using parametric and historical VAR. Now in practice, financial planners do not use historical VAR the way we're going to, but I want to show it to you because I think you should ask that question. And I'm going to show you how that can be a really powerful thing. It can be embarrassing too, so you're going to see it might be something you don't want to show because it's really hard to explain, but we'll try to explain it. I'll try to give you some words to help explain it. The second thing you're going to do is perform a style analysis. The best way for me to define a style analysis is to actually do one. So there is a good article if you want to read ahead. You don't have to do that. I'm going to show you how to do it, and I think it will make sense as you see it. So style analysis is trying to figure out, I've got this portfolio, what risk is it taking? We call it the beta risk. Remember in the Arnott article, he had alpha risk, beta risk, or asset risk, and ALM risk. So here what we're really focusing on is the beta risk. What asset classes is this portfolio exposed to? So that's the second thing you'll do. I'll show you how we'll fit this into the entire overall project. And then the last thing we're going to do is attribution analysis. So you're going to perform an attribution analysis for a client of some mutual fund. You're going to pick the mutual fund. In fact, for number 2, for the style analysis, and number 3, the attribution analysis, you will pick your own mutual fund. They're different mutual funds, and I'll explain why they're different. So you're going to assess things. Attribution analysis is really powerful, really important to understand. Looking at things like alpha, tracking error, Sharpe ratio, Trainer X ratio, Jensen's alpha, batting average, upside downside capture. There's several things I'll show you. In fact, I may not show you all of these on the Sharpe, Trainer, and Jensen's. I might say go out and figure it out on your own. So I might have some where I say you go figure it out on your own. You can see the formulas. Some of them are easier to do than others. The Sharpe is the most difficult because you have to bring in one extra piece of data that I'll show you. I might show them to you, but you should go out and read about them. They're not used as much in practice as college professors who teach this stuff think they are. The industry uses them some. They're usually there. You can get them, um, but they're not used as much by the actual portfolio manager. So that's the three things we're going to do. So let me explain high level what you're going to do. So you run your efficient frontier, you make a recommendation to the client. Then we're going to pretend that your client says, okay, I see your recommendation. I've got this balanced mutual fund that I've been using, and I'm wondering, can I use that mutual fund to implement what you're recommending in number one? So in number two, you're going to say, okay, you come to me with this mutual fund. You want to know if you can use this mutual fund. I'm going to run a style analysis and see if this mutual fund you have is actually a good fit for my recommendation. Make sure you're listening really carefully right now. Most, if not 100% of you, the mutual fund you look at number two will not be consistent with what you're recommending with number one. I've had a few students say it was consistent, but even then it wasn't all that consistent. The reason I'm telling you that is there's at least 4 or 5 students every semester that I do this who think they have to find a mutual fund that meets their recommendation under number one, and that is not what we're looking for here. You will not be able to find a fund. The allocation this model is going to give you is not going to match any mutual fund you're going to find out there. So you're going to do this analysis, this style analysis, and you tell your client, no, this mutual fund does not fit my recommendation for you. All right. That type of mutual fund you're going to do for number two is a balanced fund. It's an asset allocation fund. It's a fund that has stocks and bonds in it, just like you're recommending on number one. It'll make more sense when we get into it. For number three, your client comes to you again and says, okay, well, I can't do the mutual fund I had in number two, but I've been using this large cap value manager the last several years, and you're recommending some large cap value stocks. So I'm just wondering, could I let that manager be my manager for large cap value? And so you're going to do attribution analysis and let your client know how good of a job has this manager done historically. All right. And if you think about it, this is really powerful stuff. This is what financial planners do. Most of them don't do it themselves. Most of them go out and use Morningstar or use Lipper or FactSet, and they just have it do them for them, and they don't even know what these software packages are doing. So what I want to do is actually show you by hand that you actually work it out so you can see exactly what these software packages are doing. That way, when your first job and you're using Lipper, you're using Morningstar, you're using FactSet, you're going to have a much deeper understanding of what these software packages are doing. You won't just be plugging stuff in and getting numbers out and having no idea what they did. So I'm hoping this will give you a great insight into what you're actually doing in a typical job. So here's the Excel model. It's got several pages to it. You won't be using all of these pages. You use the model page, the output page, you'll use the historical bar, the style analysis page. You'll use the efficient frontier graph, but you'll just copy and paste it into your paper. The stuff down here at the bottom, the asset returns, the pace values, return assumptions, risk, correlation, you don't need those unless you just want to look at them. But you'll use everything here from model through style analysis graph. All the rest of this is just the guts and the assumptions for the model. If we look at the model, let's look at it. It's an efficient frontier model. We have 9 asset classes. We have large company U.S. stocks that are really large companies that are on the growth side versus value. So what is growth versus value? Growth companies, they look expensive, but they look expensive because they're fast-growing companies. Growth has done really well the last few years, where you've had Facebook and Alphabet and Netflix and Google or Amazon, what we call the FANGs. So you've had those stocks doing really well. Those are growth stocks. They've done really well historically. Value stocks, they have not done well recently, but over the long term have actually done quite well. Those are stocks that are looking expensive, but they typically have some problem. Maybe recently they haven't had very good earnings, or maybe they're challenged in some way. Maybe they have too much debt. They tend to be lower quality companies. They tend to do extremely well in strong economies and tend to be somewhat hampered by weak economies. Then you have small companies growth and value. So these 4 here are U.S. stocks broken between large cap and small cap, large companies, small companies, and broken between growth and value. Then we have our international stocks. We have developed market stocks and emerging market stocks. I put gold in there because gold, as we talked about, is a really good diversifier. Bonds, just investment grade bonds, and then high yield bonds, very dangerous bonds in terms of the potential for default. They won't do well in a recession. So here's our asset class. Here's our expected returns. If you go back, we talked earlier about how I get expected returns. I'm taking for stocks their current dividend yield. I'm adding back what we call a buyback yield. We don't need to get into that. And then expected earnings growth. So essentially, what are they currently yielding and how fast they're expected to grow. I did that for all of the stocks. For gold, I just assumed gold would earn inflation maybe plus 1% or something. Just it's hard. Gold is a hard one because you just can't. There's no way to forecast gold. It doesn't have a cash flow. You can't really value gold. Bonds, I just use their current yield for investment grade bonds. For high yield bonds, I use their current yield, but now subtracted out 1% to cover for defaults because obviously some of these bonds are going to default. So that's my return assumptions, my risk assumptions based entirely on history. And they make somewhat of sense. Value stocks are less volatile than growth stocks. Developed market stocks are a little bit more volatile than U.S. stocks, but not much. Emerging market stocks are pretty volatile. Gold is very, very volatile, but remember, we don't buy gold for the high return and low volatility. We buy it for its low correlation to other asset classes. Bonds are very low volatility, and in high yield, my assumption for a high yield is probably going to get kicked out of this model. It's not going to like it, but we'll see. Historically, the model has really loved small cap stocks, has really loved emerging market stocks. For high yield, the model may not like high yield at all because I've pulled back on my return assumption for both bonds and high yield because interest rates are down so low. High yield, the actual high yield of high yield mutual funds is about 5%. And boy, that just does not look like enough spread over investment grade bonds. I didn't assume a 5% return because there's going to be some defaults. But I'm just not sure the model is going to allocate anything to high yield at all. But we'll see. I haven't run the model yet. We're going to try it. My correlation, here are my correlations. And these are based entirely on history. We know that's an issue because history is very unstable, but we need some assumptions. So we're going with that historical assumption. You can see large cap value is highly correlated to large cap growth. Small cap values highly correlated to large cap growth. You can see small cap and small cap are correlated to each other. Bonds, where you see those slight negative, the closest zero numbers. So remember, Malkiel says, oh, it's a negative correlation now. I didn't go with the negative. I used a longer term perspective. But a few of them are slightly negative, not nearly as negative as what he was showing. Gold is not negatively correlated, but it is low correlation. High yield is highly correlated to stocks, even more so than it's correlated to bonds. So high yield bonds are more highly correlated to stocks than they are to bonds. So there's our assumptions. You don't have to test these assumptions. All you have to do in your project is acknowledge that you're using my assumptions. Some students will create a nice, pretty chart to show all the assumptions. Some actually go in and define what the asset classes are. That's not a bad thing to do. They're very easy to look up. So again, large cap value, large cap growth, large cap value, small cap growth, small cap value, developed market stocks, emerging market stocks. So there's all of our stocks. Gold, our one commodity, bonds, investment grade bonds, and high yield bonds. So now what we're going to do is we're going to run the efficient frontier. So you're going to be working in this green area. You don't have to do anything with the blue area other than maybe you summarize it in your paper. So you're going to be spending all your time here. But let me show you what I do in the orange area, which is where the calculations actually are. So we have two calculations. We have an expected return. So the expected return, remember, that's really easy. Here's all the returns we saw up at the top. 795, 785, 875. There's all of our returns. Here's our allocation, adds up to 100%. So you just multiply your weight times the return, add that up, and this portfolio has an expected return of 847. So what is it expected risk? Well, remember this formula? The expected risk is the weight of A squared times the risk of A squared plus B squared plus 2 WA, WB, risk A, risk B in correlation. So what we have to do first is this first part of it. Weight A squared times risk A squared. So there we have the weight of A squared and the risk of A squared. We add those two together. So that takes care of that for A, takes care of that for B, for C, for D, E, F, G, H, I. So we have all the asset classes. We just add that up. That's that first part of the equation. So now we got to do the end of the equation. 2 times AB, AB, AB. 2 times A and C, AC. 2 times A and D, AD. 2 times B and C, BC. So we have to do every single combination. And the way I do, I set that up as a little pyramid. So I do each one. So if you look at this one, we have 2 times B32. Well, B32 is the weight of large cap growth times B34. Well, B34 is the risk of large cap. No, I think that's the weight. Actually, that's the weight of small cap growth. Times C47, that's the risk of large cap. Times C49, that's the risk of small cap. Times B8, that's the correlation. So if you go back and look at B8, B8 is the correlation of large cap growth to small cap growth. So B8, large cap growth, small cap growth. So I'm just doing every single possible combination down here. And then the sum of all of that, so there's the sum of the first part of the equation, there's the sum of the second part of the equation. We add those two together, and the square root of that is our risk. So if you go up to the return just goes out and references this 847. If you look at the risk, it adds those two numbers together and takes the square root of that. Alright, so I had to switch computers because of a technical issue, so this part of the video might look a little different. But now what we want to do is actually start running our efficient frontier. So this part of the video, if you possibly can, be watching the video on one source and then be working on the Excel file on a desktop or a laptop. That would be the best. So you definitely want to have the Excel file open at this point so you can just follow along with me as we go. So very, very, very important. So definitely try to be, if you can, you may even have to watch the video on the phone, although I'm going to be getting into the files, so you need something you can see somewhat what I'm doing. But try to follow along. To do this part of the video, you need, if you click on data, you need to have solver loaded. If you don't have solver loaded, then you need to go to file, and when you click on file, you'll see options. So you click file and options, and you want to do add-ins. You want Excel add-ins, click on add-ins, Excel add-ins, say go, and then make sure solver is checked. So you have solver loaded. So what we're going to do is, in the model here, the first step you have, step one, is you need to define your client. Alright, and you also need to define your constraints. So let's talk the constraints first. What's the max you're going to allow your client to have in high yield? The typical is anywhere from 0. Some people say no high yield at all. Some might go as high as 20%. 20 is probably getting to the extreme on high yield. On gold, how much will you put in gold? I've seen one presentation, they were doing 25% in gold as their target. Boy, that seems awfully high. At UTSA, we would generally be in the 5 to 10% range. Well, what's the max you want to have in gold? Remember, gold is a good diversifier, but it's also a very volatile asset class. So once you get up to a certain level, it starts taking over the portfolio in a way. And then on international stocks, what's the max you want to have in emerging market stocks? Remember, now Malkiel was recommending 17% in emerging markets. That's a pretty high allocation to emerging markets. So somewhere probably in the 10 to 30% range is where you might be. International stocks, that what we do there is we add emerging and We add emerging and developed stocks together, B21 and B22. We add those two together, and we look at that as a percentage of the overall portfolio as well. So what's the max you have in international stocks? That one, the U.S. stock market's generally about half of the world stock market, so 50% might make sense. So real critical, when you build your model, at least one of these constraints must be different. You got to change one, and you just have to find some creative way to explain why you came up with that particular constraint. If you want to do a little bit more Google research, you could probably Google what should be the max allocation to high yield bonds, what should be the max allocation to international stocks. There is something out there on the internet, it's called country bias, and that is most people over allocate to the country they live in. So if you live in Japan, you're going to put way too much in Japanese stocks. If you live in Europe, you'll put way too much in European stocks. That's the what we call home country bias. Home country bias. So that's actually a term you could look up and get some people's perspective. I'm not saying doing a lot of research here, but you have to have some rationale for your constraints. So these are my constraints, 10, 10, 20, and 40. Your constraints on at least one of those must be different. That's the first thing we're going to do. The second thing is you need to define your client. You're going to make up a client that you're going to say how they started when they came to you, and you're going to then give them a recommendation for a different portfolio. So your best thing to do here is to have a client who's not very well diversified. I'm going to show you what I'm going to create. I'm going to put a client who has, say, 70% in large cap growth, 10% in bonds, and 20% in high yield. That's going to be my client, all right? You have to make sure whatever you do needs to add up to 100%. Another thing that would probably be important, and I'm not doing it with mine, so I'm going to switch these. I'm going to do 20 and 10. It's probably best when you set up your client that they not violate your constraints. So see, if I did 10 and 20 on high yield, my high yield actual is 20, but my constraint's 10. I recommend you don't do that, because what that could mean, by pure random chance, is possible that your recommended portfolio might actually be a lower returning portfolio than your client's portfolio, because your client is violating your policy. So I'm going to do 20 and 10, or even better, I'm going to do 10 and 20. I'm going to change my constraint to 20. All right, so I've changed the rules on you. So my max high yield is 20, gold is 10, emerging is 20, international is 40. That's probably better, because I doubt many of y'all will actually have a high yield as high as 20. So I've got some constraints that probably will not be consistent with what you're doing. But do try to make sure whatever you set up as your client, that it doesn't violate these. Now, if you want to set up other constraints, you certainly can. One thing that's really cool that you might try is to set all your constraints to 100 and actually run the efficient frontier unconstrained. You could even add that as extra analysis to your paper if you wanted to add something, a little more interesting to talk about. But anyway, you have to define your client. Make sure your client, however you define them, that they're within your constraints. Make sure you have your constraints. Once you do that, then you go to model output. And the first thing you want to do is just get rid of anything that's in this section. So just hit your delete key and just get rid of that. And whatever you just did on the model page is going to be on this first line. So make sure you don't delete this first line. Highlight this first line. So highlight all of this. And when you set up your client, you want to right click and copy. And when it says current portfolio, you want to put your client on that current portfolio. Put your client right there. And then we're going to build the efficient frontier below this. So now go back to the model. Now what we're going to do is we're going to build the efficient frontier. We'll start at, say, 4% risk. Now to do 4% risk, right now our risk is 12.71. So we want to run solver to find the highest returning portfolio at 4% risk. What I like to do is give solver give my allocation somewhere close to that my target risk. So I'm going to do 15% large cap growth, 85% bonds, and that got me pretty close to that 4% risk. It doesn't have to be exactly the same, but something close, just so you're in the ballpark. Sometimes Solver has problems finding the solutions, so you might do exactly what I just did. Start with a target risk of 4% and then do 15 and 85. Then we're going to click on Solver. Let's look at Solver, the great tool. What Solver is saying is we want to maximize B28. B28 is our return. So we want to maximize B28 by changing B17 through B25. That's my asset allocation. That's what the Efficient Frontier is going to do. It's going to find the best allocation that give you the highest return. We want to make sure that our risk equals 4%. So you want B29, the calculated risk, equals E17, the risk we entered. We want to make sure B27, which is the sum of all our asset class weights, that equals 100%. And then we want the model to be in compliance with our 4 constraints over here. Then we just click Solve, and we let Bill Gates do his work. And when Solver comes up, there's three solutions you can get. The one you're hoping for is that Solver found the solution. The other two, one might be say that Solver converges on a solution. If you get that, you just click OK and you run Solver again. You might get the Solver could not find a solution. Sometimes that's because you're in kind of a weird area for Solver and just can't figure things out. And to solve that, sometimes what you can do is just give it a new starting point. One thing I suggest, if you're really having struggle for Solver find a solution, try an equal weight. So there's 9 asset classes. So put whatever 1 divided by 9 is here, and then try Solver. That can work as well. Sometimes it's not going to work because you're at a point in the risk that risk level doesn't exist. Maybe your risk level is way too low. If I put a 2% target risk, it probably couldn't find a solution. If I put a 40%, it probably couldn't find a solution. So you might have gone through the bounds. But if you're in somewhere in the middle between 4 and 15%, and it cannot find a solution, and you've tried a few times, don't do it for hours, do it a few minutes. It just, you've gone 5 or 6 times and it can't find a solution, then save what you have, email it to me. I'll figure out what's going on and email it back to you so you can get started again. So don't waste your time with frustration if something's going wrong. If you're using a Mac, an Apple, Solver has some issues with Apple. I don't know if they fixed it. Depends maybe how old your machine is, so it's possible. You just have a software problem. Go back to model output. So now that 4% risk is right there. So we can now copy that and we put it on the line right below our current portfolio. Paste it as values. So you right click and click on that 1, 2, 3. And we've got our first point built. Now we're going to go to 5% and we'll run 5% Solver, solve. We see if you can find 5%. It's searching. You can see it's searching. It found the solution. That's good. We go over to the 5% and we'll copy that. Put it on the next line down. And if you go over to the Efficient Frontier graph, you'll notice that it's starting to build our Efficient Frontier. There's our current portfolio right here. That's that one we set up. We'll figure out what our recommended portfolio here is in a second. But it's starting to build the Efficient Frontier. So let's go to 6% and run Solver. It found the solution. That's good. So I'll highlight that. This is going to get somewhat repetitive here, but it's good practice. 6%. You can see our Efficient Frontier continues to build. Let's go back. Let's try 7%. It tends to go pretty, once you get the first point to run, it tends to go pretty fast. Found the solution. Copy. Put it right there. Still coming. It looks like we're going to go to about right there, so we slightly above our current portfolio, but we'll see. Let's try 8. Found the solution, so that's good. Now, one thing I'm going to warn you about right here, and this can be an issue for you. This line right here, line 13, that's where my solution is. The solution I'm going to do is I'm going to find the highest return at this 12.71. So I've got 9, 10, 11, 12. So I kind of want this to be in order. You'll see as we get closer, but this is one thing to be aware of. So, you know, our efficient frontier is looking nice and smooth. There's not any bumps in it. So, you know, sometimes you go 4, 4.5, 5, 5.5. Or does 4, 5, and 6 work? 4, 5, and 6 is working pretty well. We can probably jump here to let's jump to 9.5%. We'll go kind of in between. You'll see what I mean when we get to that point. So here's 9.5%. We'll copy that in. Look at that, our fish frontier. It's coming along pretty well. So let's try 11%. The solution. We haven't any trouble finding solutions. We'll do that. It goes right there. And so I want this next line to be my recommended. So what I want to do is take my risk on this current portfolio. This is not the solution you have to have. There are a lot of other solutions you could try, but I'm going to do this. I'm going to copy this risk level that I had for my current portfolio, and I'm going to paste it as a value on my target risk. I'm now going to run solver on that point, and it had no trouble finding solutions, so I'm going to make that my solution. I'm going to copy that and put that on my solution line. Now when we look at the efficient frontier, we see that our recommended portfolio is right here. It's the same level as our current portfolio, but much higher return, much higher expected return. So let me just, while we're here, that doesn't have to be your solution. So one solution you might have is, let's say you have someone who's 65, 70 years old, and you put them 80% in stock as their current portfolio. You might have their current portfolio way over here, but your recommended portfolio might be over here. So you're actually recommending they get a lower return because you want to greatly reduce the risk. Or you might have a young investor who's like 20% stocks way over here, and you're going to recommend they come up here. So there's other solutions. This is the most common one, that you take where they are currently and you just move them to a higher return. But there's a lot of different ways you can do that. I could have run the model. You'll have to sit down and use your critical thinking. You can get this model. You'll have to change solver, but you could find a model that says, you know what, I want to be at the current, I want to have the exact same return as my current portfolio, but much lower risk. So you might actually recommend this. You'd have to get solver to figure out, you'd have to, instead of trying to maximize the return, you would try to minimize the risk, but have solver has to equal the current return. So there are ways you can do this, but this is the most common approach most students use. All right, so now we can go to, say, maybe go to 14%. We say solve, found the solution, no problem. You can put that on the next line. Efficient frontier just keeps on cooking there. Let's try 16%. At some point, solver will not be able to find a solution. 16 works pretty well. I forget how far I had the efficient frontier go, to about 16%. So let's try 17, and that's about. Now you might say, well, why can't we go to 22% or 36%? Well, emerging market and gold, they are 22.5 and 36, but you have them constrained. You should be able to get to 22% because you're not constraining small cap growth. So you could essentially have a 100% in small cap growth. So 22 could be your furthest out point out there. And there you'd probably have some small cap, some emerging, some gold, probably have some other things that get you to 22. So you probably can get up there well above 17, but we don't really need to go that much further out unless you can if you want to go out further and change the constraint. you can. But let's stop at 17. In fact, let's do it at 18 and see if we can get 18 to work. Found the solution. That should be enough from our graphing standpoint. If you look at your first frontier, it looks pretty good. If you want to add the 18%, you certainly can. If you just don't like it stopping like that, so up to you, however you want to have it. And so there's my current portfolio, my recommended portfolio. There's my current portfolio. You just move these over. I have students that turn this in with the paper, and the recommended is way over here, and the dots here. So there's your first frontier. You'll essentially just copy and paste this into your paper as a bitmap. Here's your output. Now, why is this output so important? Where there's some graphs over here, charts over here, that have your current portfolio and your recommended portfolio. This recommended portfolio only makes sense if what you're recommending is actually on the green section here. Now you notice it's a little hard to read. So if you want to get rid of the ones that have zeros in them, you can certainly do that. So you just have the ones you're using. So if you can see wow, this is pretty wild, radical, recommended portfolio. I don't think I would actually recommend this portfolio. But your current portfolio is heavy in growth stocks, and we're recommending heavy in value stocks. 16% in bonds, no high yield at all. Emerging 20%, that went right to our constraint. So pretty radical allocation. I don't think I would ever recommend that much all in value stocks. However, right now probably is a good time to be in value stocks. But this model loves value stocks because of their return and risk characteristics. So the model's going to do whatever. Now, you might say, you know what? That much in value stocks, it can't be that radical. So you might say max value stocks, and you might say, hey, I don't want more than 30% in value stocks. So you could set up another constraint. What are your value stocks? Where your value stocks are large cap value and small cap value. So you put that over, and then you would have to add this to your solver. You want to make sure that this cell is less than that cell. This cell F is less than that. You could also do the same thing on max growth and just add up your true growth. If you want to add constraints, you can certainly do that. Now if you add constraints, let's say you don't want that to be more than 40%. So if you add constraints, you don't have to change the other constraints. You can leave these other constraints exactly like I have here. So if you add new constraints, that's good enough. You've changed the model enough that you have constraints. So if I did this, it would probably give me a different answer. And so, it's just, and we can even look and see how much different the answer would be. So I'll bring in this, and I'll put it right there. And then when I do data solver, I have to add new constraints. So I'll say I want that to be less than or equal to that. Add another one. I want that to be less than or equal to that. Say OK and solve. Found the solution. Let's look at it. So my recommended had 1271 and 743. With these constraints, I have 1271 and 721. You can see I gave up about 22 basis points there. So what did it do? It put 40-40. Boy, it just put exactly 80%. That's kind of strange as well. It's really bizarre. It's really, I've always found it fascinating. The bonds were about the same, 16%. For some reason, when I forced it to put money in the growth stocks, it cut back on my emerging market stocks. So anyway, so you can definitely do that. Mine's 24 and 25. Get rid of those. So Now if we solve it, we should be back to what we had before. Should give you the same answer, and it did, 1243. So, it's up to you. You have the right to manipulate this model in some ways if you like to. Don't change the assumptions. Leave the assumptions the same. I highly recommend against changing the assumptions. But you can add constraints if you like, additional constraints. And then your recommended can be all kinds of things. So I could have a portfolio way down here I recommended, or my current portfolio could be way down here, and my recommended could be way up here. Your choice. I would recommend you do something fairly radical so that, what you don't want, and I've seen this, is that like your current portfolio is right here, right below your recommended. So your recommended portfolio is like 2 basis points higher expected return than your current portfolio. Just not too exciting to do that. So try to do something radical. That's why I like the ones where they say, their portfolio is okay, but it's just too high risk. This is a 70-year-old that has 80% of their money in stocks. We need to bring them down here in this range. So there's all kinds of things you can do. It's your choice. But you see the one issue we have is we want our recommended portfolio on this line. Now, let's say you are actually recommending this portfolio. You can actually copy this portfolio and put it, you can put one out of order on your Efficient Frontier, but it does cause this little thing here. It does cause a little bit of mess up on the Efficient Frontier. It's not bad, but it does mess it up a little. So your Efficient Frontier looks better if everything is in order. If you're comfortable with Excel and you want to change this green instead of changing it there, let me put it back here. Let's say you want to pick this as your portfolio. Just be aware you've got to change this graph here. You'll have to change this point here, and then on the historical VAR you'll have to change. You have to change this recommended line here. So there's 3 places you'd have to change it. So just be aware of that. If you want some help, I don't want you spending time building an Excel model. So if you need some help, email me and tell me what you want, and I'll fix it for you, because I know this spreadsheet extremely well. I don't mind doing that. It takes me 5 minutes. That it's really frustrating to use somebody else's Excel model. So send it to me. I'll fix it in 5 minutes. Send it back to you, and that's a lot better than you spending hours trying to manage somebody else's spreadsheet. All right. So we have the Efficient Frontier built. You see how the model works, how the model output works. You'll put these 2 charts into your paper. Remember, you might have to undo the 0% in there if you want to. I would recommend you wait and do that at the very, very end. So, and then you have the Efficient Frontier that you can actually build. So what we'll do next video is we'll do the historical VAR. We'll do the style analysis, and we'll probably get into manager attribution. So we might actually finish everything this next time.